Hi everybody, and welcome back to video number 2 in chapter 21. And when we left off, we were looking at comparative information related to an accounting change, in this case FIFO, for the Lancer Company. And we're showing here the effects of our net income from, Okay, so note A here, a change in method of accounting for inventory valuation on January 1, 2025. Lancer Company elected to change its method of valuing its inventory to the FIFO method. In all prior years, the inventory was valued using LIFO, etc., etc. So they have a descriptive note here telling exactly what went down and the numbers affected by the change in that accounting principle here. And the result of the accounting change, retained earnings as of January 1, 2024, increased from $120,000 as originally reported using the LIFO method to $122,000 using the FIFO method. Okay, so here's the retained earnings statements given LIFO. So we have retained earnings beginning. We add the net incomes, which we've got here. That was, and then we computed the revised retained earnings. Okay. So refer to the information in illustrations 21.4 and 21.6. The difference between the retained earnings balances under LIFO and FIFO are computed here, $2,000, which we showed previously. The question is, how would Lancer's retained earnings statement be presented in 2025? Given the change in accounting principle in 2025. So comparative retained earnings statements for 2024 and 2025, given effect to the FIFO, are as follows. Here we go, 2025 it should say, and 2024. Retained earnings beginning, we're going to add the adjustment here for the cumulative effect on prior years of applying retrospectively the new method of accounting for inventory. And here's that $2,000. And that gets us up to $122,000. And then our net income is $89,000 and $103,000. Okay. So as indicated, Lancer's adjusted beginning balance of retained earnings on January 1, 2024 for the excess of FIFO net income over LIFO net income in 2023. The $2,000 difference is referred to as the cumulative effect. And as comparative presentation indicates, the type of adjustment that the company needs to make. It follows that the amount of this adjustment could be much larger if a number of prior periods is involved. All right, other accounting change issues. Here, we're going to look at some additional considerations related to the changes in accounting principles, including the following. 1, direct and indirect effects. 2, impracticability, and 3, non-qualifying changes. Okay, direct and indirect effects of changes. The direct effects, here FASB takes the position that companies should retrospectively apply the direct effects of a change in accounting principle. But also the indirect effect is any change to current or future cash flows of a company that results from making a change in accounting principle that is applied retrospectively. So let's take a look at indirect effects of the changes in accounting principle with an illustration. Here, continuing with our Lancer example, assume that Lancer has an employee profit sharing plan based on net income. As illustration 21.2 showed, Lancer would report higher income in 2023 and 24 if it used the FIFO method. In addition, let's assume that the profit sharing plan requires that Lancer pay the incremental amount due on the FIFO income amounts. So the question would be how would Lancer report this additional expense caused by the change to the percentage of completion method? So in this situation, Lancer reports this additional expense in the current period. It would not change prior periods for this expense. If the company prepares comparative financial statements, it follows that it does not recast the prior periods for this additional expense. If the terms of the profit sharing plan indicate that no payment is necessary in the current period due to this change, then the company need not recognize additional profit sharing expense in the current period. Neither does it change amounts reported for prior periods. Lancer should report this additional expense in the current period only. If Lancer prepares comparative financial statements, it follows that it does not recast the prior periods for this additional indirect expense. Impracticability. Here, companies should not use retrospective application if one of the following conditions exists. 1, the company cannot determine the effects of the retrospective application. 2, retrospective application requires assumptions about management's intent in a prior period. And number 3, retrospective application requires significant estimates that the company cannot develop. If any of the above conditions exists, the company prospectively applies the new accounting principle. Let's take a look at an illustration. Here, Williams Company changed its inventory method from FIFO to LIFO, effective January 1, 2025. Williams prepares statements on a calendar year basis and has used FIFO method since inception. Williams judges it impracticable to retrospectively apply the new method. So the question would be, how should Williams account for this change in accounting principle? And as we look at the solution, using the retrospective approach for a change in LIFO is generally considered impracticable because determining prior period effects would require subjective assumptions about the LIFO layers established in prior periods. These assumptions would ordinarily result in the computation of different earnings figures. Therefore, the only adjustment necessary is to adjust the beginning inventory to establish the beginning LIFO layer. Williams must disclose only the effect of the change on the results of operations in 2025, the period of change. So, if a disclosure to the change to LIFO, when a company cannot retrospectively account for a change to LIFO, it should explain the reason for omitting the computation of the cumulative effects for prior years. And here Quaker Oats does this exact thing. And it indicates here that effective on July 1, they adopted LIFO for valuing their inventories, and the company believes that LIFO better matches current costs with current revenues, and the cumulative effect of this change on retained earnings at the beginning of the year is not determinable, nor are the pro forma effects of retrospective application of LIFO to prior years. The effect of this change on current year fiscal results was to decrease net income by $16 million, or 20 cents per share. So if the LIFO method of valuing certain inventories were not used, total inventories would have been 60.1 million higher in the current year and 24 million higher in the prior year. So if we look at non-qualifying changes, not all changes qualify as a change in accounting principle. Here are two situations in which a change has occurred but does not qualify as a change in accounting principle. One, adoption of an accounting principle for new transactions, and two, correction of an error. Okay, let's put this into practice. The Denson Company has been in business for many years, but 2023 was the first year of operations for its construction division. Denson reports its financial information on a calendar year basis. The beginning balance of retained earnings on January 1, 2023 was $1,360,000. Denson has accounted for its income from long-term construction contracts at a point in time using the cost recovery method. In 2025, as a result of adopting new revenue standards, the company changed to recognizing revenue over time, the percentage of completion method. For tax purposes, the company uses the cost recovery method and plans to continue doing so in the future. We are assuming a 20% enacted tax rate. The following shows portions of three income statements for 2023 through 2025 for both the cost recovery and the percentage of completion methods. So here they are. Income statement using cost recovery method and the income statement using the percentage of completion method, both using a 20% income tax rate. So alpha here, they want you to record the adjusting entry necessary to record a change from the cost recovery to the percentage of completion method in 2025. And then for Bravo, prepare Denson's comparative financial statements for 2025 and 2024 using the percentage of completion method. All right, so for alpha, the entry to record the accounting change at the beginning of 2025 is as follows. We'll debit construction in progress or process for $220,000. We'll credit deferred tax liability of $44,000 and credit retained earnings for $176,000. And we get those numbers from here. Okay. Now, to determine the impact of changing to percentage of completion method, Denson's going to calculate the difference in income for the years prior to the year of change, which was 2025. And the changes in revenue will also trigger changes in the tax owed. So the analysis follows. Here's our pre-tax income for 23, 24, and percentage of completion, cost recovery, difference in income. We'll multiply that by 20% and come up with our income tax effect. That looks like a good place for us to stop this video, and when we return, we'll continue on with the explanation of alpha. Until that time, Bye for now.